Today we're going to look at stockholders' equity and through 5 learning objectives like we generally do with these integrated PowerPoint shows. And also we're going to look at a supplement which relates to stockholders' equity for forms of businesses or organizations other than the corporation. Our first learning objective is to explain the role of stock in financing a corporation. As you might recall, when a corporation wants to conduct business, it takes resources in order to do that. They can either finance the business through ownership, i.e. issuing stock, which we call stockholders' equity, or they can borrow the money. And what we are looking at today is the role of issuing stock, bringing on owners in order to finance the operations of an organization. And one of the advantages of the corporate form of business is that it's much easier to raise money compared to the proprietorship or the partnership, for example, where all the money generally has to come from the individual or the partners who are involved in the business. Both large and small investors can own shares of stock and participate in corporate ownership, which makes it a bit easier for corporations to raise money. It's simple to become an owner. All you have to do is participate in an IPO, which is an initial public offering, or you can buy and sell stock on the secondary market, which is the stock exchange. It's easy to transfer that ownership because there's a ready market for stock where you buy and sell on exchanges, and it also provides limited liability, whereas for a sole proprietor or partnership, if something happens in the organization that creates a legal problem, it is the owner's problem, whereas in a corporation, legal problems only accrue to the corporation itself, which is a separate legal entity, and therefore the owners or the stockholders are not liable for the actions of the corporation. Benefits to the stockholder through corporate ownership include voting rights. Common shareholders can vote on who's going to be on the board of directors and other major policy type issues for a corporation. The stockholder receives dividends if the corporation elects to declare and pay dividends. The stockholder also receives what we call residual claim. If a corporation were to go out of business, once all of the other claims against the corporation have been settled, a stockholder as an owner will get what's left. And then finally, there's this thing we call preemptive rights. If a corporation is going to raise additional capital by issuing more stock, the current common shareholders have the right to purchase that stock before it goes on sale to the public, so that they can maintain or maybe even increase their percentage ownership in the corporation. So as you can see by this slide, stockholders, the common stockholders are owners of what we call voting shares in the corporation. Therefore, the stockholders elect the board of directors for the corporation. Now, the board of directors appoints the president. So really, the stockholders can control quite a bit about who runs the organization and how it's run if you hold a major share of the stock. Of course, if you're a minor stockholder, your vote isn't going to really count for much. So let's take a look at the difference between equity versus debt financing. Remember, equity is when we issue stock, is what we're talking about now. But we want to compare that to financing our corporation through debt. So advantages of each. Advantages of equity include the fact that equity doesn't have to be repaid. Once you have an owner in the company and the owner invests the money in the company doesn't have to repay that owner. If the owner wants out, he or she can sell their stock, through the stock market or some other vehicle, but the company does not owe the owner any money, doesn't have to pay back that stock. Also, dividends are optional. A corporation does not have to pay dividends. Some companies elect to pay dividends. Other companies elect to reinvest all of their income back into the company. And that's just a strategic decision made by each company. Now, advantages of debt are that if you take out debt, you pay interest on that debt. Interest on debt is tax deductible for the corporation. Dividends are not tax deductible. Dividends are considered just a distribution of income to the owners, and then the owners, i.e. the stockholders who receive dividends, have to pay taxes on that. Debt also does not change stockholder control. So instead of issuing stock, additional stock, which can rearrange percentage ownership for various stockholders and whatnot, debt doesn't do that. If you take out a loan, you have to repay the loan. It has nothing to do with the ownership or ownership percentages in the organization. So now we'll take a look at the transactions involved when we issue stock. In other words, when we take on new owners in our corporation. So recall from our earlier looks at the accounting equation, there are two primary sources of stockholders' equity. One of those is the contributed capital, i.e. the stock. And remember, when we issue stock, we have some kind of a par value associated with that. We'll be taking a look at that again. So under contributed capital, we have common stock, and then this other account we call additional paid-in capital. Then we also have retained earnings. And remember again that retained earnings is our net income from the beginning of our business until now, less any dividends that we might have paid out from the beginning of our company until now. So a few things we need to know about stock: authorization, issuance, and repurchase. When a company becomes files the paperwork and goes through the legal proceedings to incorporate, at some point that corporation is authorized to issue a certain number of shares of common stock. Now, oftentimes, I might think most often, the company won't issue all of the shares that it's authorized to issue, especially in that initial offering. They'll just issue some of the shares that they're authorized to issue, and that will be their outstanding stock. So they then issue shares, and that's where they bring the contributed capital into the organization so that they can run the business, and now they have owners. And occasionally, a corporation will decide to repurchase some of its own stock, and we'll take a look at those transactions. Those are called treasury stock transactions, and we'll look at those as well. So we have the authorized shares, which are issued shares, a certain number of shares that they're authorized to issue. We have also then unissued shares of stock. So under authorized shares, we've got those that are issued, and then a number of shares that were authorized to issue but haven't issued yet, and we can consider those unissued shares of stock. And then we have this third thing. If we have shares outstanding, see the left side of the illustration up there. We have outstanding shares, and then we have treasury shares. If we have repurchased some of those outstanding shares and hold them in the corporation, those are called treasury shares. So our authorized and issued shares can include both outstanding shares, those are shares owned outside of the company, and treasury shares. So let's take a look at the stockholders' equity section of the balance sheet. So what you're looking at here is a part of the balance sheet. It's the stockholders' equity section. And see that it's a comparative balance sheet. We're showing both 2008 and 2007 in this particular section. And as you would always show a couple years in your balance sheet. And so the first section of the stockholders' equity section is called contributed capital. That's where we show all of our stock. And there are different types of stock, as you've read about. There's preferred stock, and then there's common stock. Common stock is the ownership of the company. Those are the shareholders who can vote on the board of directors, and so those are the main owners of the company. So you see common stock, it shows the par value of the stock, and that's what you record common stock at when you issue the stock, is its par value. And then whatever you get beyond that par value, and par value is usually a small number, just kind of a nominal amount on that stock, and then what you get above that par value when you issue the stock is what we call additional paid-in capital. You can see that account down there as well. So this stock was issued, if you total it up, for $27,008. That would be the combination of the par value and the additional paid-in capital. And of course, we also have the 150. Well, these are thousands, of course, but the 150 of preferred stock as well. So you see total contributed capital of all of our stock. And then, of course, we add retained earnings. And remember that retained earnings is the other portion of our equity section. And then look at the treasury stock. We had stock in that common stock. We had repurchased our own stock at a cost of $18,000. And so treasury stock then is a reduction of stockholders' equity. So you can see that stockholders' equity totals out at $144,625. So once again, the proceeds from a stock issuance, we record the cash we receive, of course, debit, and then we credit the number of shares we sell times its par value. The par value is, like I said, usually a very small number that is basically an arbitrary amount that's assigned to the stock when the stock is authorized, when we file for our articles of incorporation, etc. The market price is the amount that we sell the stock for, and so the difference between the par value and the what we get for it, what we issue it for, is that additional paid-in capital. And there are a few states that don't require a par value to be part of the articles of incorporation or the stock part of a company. And so that's called no par stock when it happens. And so you wouldn't record your common stock at its par value plus its additional paid-in capital. You just record it as the paid-in capital amount. So two different terms we're going to look at here. One is called an initial public offering, IPO. That's the first time a corporation issues stock. If that same corporation decides to issue more stock later on, it's called a seasoned new issue. It's just all the subsequent issues of new stock to the public. And so if the corporation decides to issue additional stock later on, it's called a seasoned new issue. In other words, it's a new issue of stock, but for a company that's already been in business. So let's take a look at how to record the issuance of stock. So generally, issues of stock to the public are done for cash. And so the company's going to get cash. After all, that's why they're issuing stock in the first place. So let's take a look at this. National Beverage Company issued 100,000 shares of 1 penny par value common stock for $10 a share. Okay, so what they really got for it was $10 a share. So remember, we have to record the cash we got, which would be the $1 million, 100,000 shares times the $10 a share, and then we're going to split up the credit to the par value, in other words, common stock for the par value of that amount, and then an account called additional paid-in capital. So analyze it. We got $1 million on the asset side. It's cash. On the stockholders' equity side, the par value of those 100,000 shares was 100,000 times 1 cent is $1,000. The additional paid-in capital would be the difference between that penny par value and the $10 per share that we got. So we record it with the debit to cash for $1 million, the credit to common stock for $1,000, and a credit to additional paid-in capital for $999,000. So once that stock is sold by the corporation, is issued by the corporation, that's the end of the corporation's involvement in the trading of those particular shares. In other words, once an investor buys stock through an initial public offering or a seasoned offering from a corporation, the corporation's done with those owners from a stock perspective. So if the owner wants to sell their shares of stock, they don't sell it back to the corporation unless it's a treasury stock transaction. What they do is they sell it to somebody who wants to have shares in that corporation. So that usually takes place on the stock market. The stock markets are institutions that were created to make it easier for individuals to trade shares of stock in companies. And what that does is it helps create this secondary market for stock, so that people are more willing to invest in stock because they can own it for a while, they can sell it to somebody else if they want to. So it's just this market mechanism that's been created for individuals or investor companies or something like that to buy and sell shares of stock that have already been issued by corporations. So as I said earlier, sometimes the company will buy it once it's issued shares to people outside of the company. Sometimes they want to buy some stock back. Why might they want to repurchase their own stock? Well, sometimes the company believes, management of the company believes that its stock is undervalued in the stock market and that it's a good deal. So they might want to signal investors that they believe their stock is undervalued, so they'll go out and buy up their own stock with the intentions of reselling it later on. And that does send a signal to the market if it's pretty clear that that's why the company is buying its own stock. Another reason is you've heard of companies buying other companies through stock and some cash. Well, what they do is they will give owners of the other companies shares of our stock in exchange for ownership of this other company. So we will buy and keep some of our own shares so that we can use them to purchase other companies sometimes. And then thirdly, we might have a stock purchase or what we call stock option plan, where we have key employees who we want to reward with shares of our stock if they reach certain performance targets and all of that. So in order for us to give key employees stock, we have to have that stock. We don't issue it. We go out and we buy it, and then we give it to those employees, or we sell it to them for discounted prices or something like that. So we have three main reasons why a corporation repurchases its own stock. When we do that, it's called treasury stock. We record it as treasury stock, and as you saw before, it's recorded at the cost we pay for it, and it shows as a reduction in our retained earnings section. So we'll take a look at repurchase of stock, for example. So now National Beverage Company is going to buy some of its own stock, and so they go to the stock market just like anybody else would, and they buy stock from existing stockholders, and that's called treasury stock. Now, once they have their stock back, maybe what they want to do is part of their employee compensation is to pay their certain employee's salary plus what we call stock options. A stock option is just what it sounds like. The employee has the option to buy the stock at a price that's lower than the market price, or at some set price. And so that allows the employees to have ownership in the company and to want to maximize the value of their ownership by doing a good job, supposedly, in their jobs with the corporation. So the characteristics of this treasury stock: if a company repurchases its own stock and holds it as treasury stock, they don't get to vote or get dividends from that stock. Remember, it's a contra equity account. It's not an asset. You debit treasury stock, which shows up as a reduction of retained earnings, and you credit the cash you paid for the stock. And so, again, treasury stock is not an asset, it's a contra equity account. So when the stock is reacquired, that treasury stock is recorded again at cost. Debit treasury stock, credit cash. So for our example, let's take a look at the repurchase of stock. National Beverage reacquired 50,000 shares of its own stock for $25 per share. So what happened? We spent $1,250,000 in order to acquire 50,000 shares of treasury stock. We said we record that as a debit to treasury stock for the $1,250,000 cost to us, and a credit to cash. So what happens if we reissue or sell that treasury stock we hold? So let's take a look at that example. National Beverage reissued 5,000 shares of treasury stock at $26 per share. Now see, that's a little bit more than what they paid for it. So what we do is we record the cash. Remember, that's an asset increasing. And we show that the treasury stock we're getting rid of the treasury stock, so we reduce the contra equity account, and we record the paid-in capital, that extra money we just made as additional paid-in capital. So again, our transaction is to debit cash for the proceeds of that reissuance for $130,000. We credit treasury stock for the $125,000 cost, and then we credit additional paid-in capital. So we don't record a gain or a loss, we just increase our additional paid-in capital by that $5,000 additional that we got from reissuing the treasury stock. No profit or loss is recognized on treasury stock transactions. So let's look at our third learning objective, and that's understanding basically cash dividends, or sometimes we issue dividends with stock. Those are called stock dividends. And then we have this thing we call stock splits. And so we'll take a look at these three types of transactions. So again, we're talking about common stock right now, and we're going to look at dividends on common stock. Now, dividends are declared by the board of directors. Common stock does not require the payment of dividends, so there's no legal requirement to do that. The board of directors might want to declare a dividend to return some of the retained earnings, if you will, to the owners of the company, and perhaps they do that to provide their shareholders with a return in the form of dividends, rather than keeping all of the money to continue to reinvest it in the company. Once the board of directors declares a dividend, then that dividend payment becomes a liability, becomes a legal liability. So the company says, well, we are going to pay a dividend. At that point, then it is a liability. They must pay that dividend. In order to declare a dividend, a company has to have sufficient retained earnings and cash to be able to pay that dividend. Remember, retained earnings doesn't mean cash, it doesn't equal cash. It's just the net income since the beginning of the company minus whatever dividends might have been paid before. That's not necessarily cash, because much of that retained earnings might have already been reinvested in the company in different assets, et cetera, et cetera. And sometimes our retained earnings can be restricted by agreements we make with lenders or other creditors. And so if we go to take out a loan, a lender might require that we restrict our retained earnings. In other words, we put in we sign a document and publicize that our retained earnings is restricted for certain amounts, and that limits our ability to pay dividends, so that the creditor can feel some level of comfort that we won't be paying our owners dividends and then not be able to repay the loan. So let's take a look at the dates and terms involved with with issuing dividends. When the board of directors declares a dividend, that's called the declaration date. And what happens at that point is we record the liability of dividends payable, and that's a credit, of course, because it's a liability. And then we debit dividends declared in our stockholders' equity to record that we have declared that dividend. And that's at that point a reduction of stockholders' equity. And then there's this thing called a date of record. When we declare a dividend, we say we're going to pay a dividend of so much per share to stockholders who own our stock as of the date of record. So if we declare this dividend on June 15th, what we're saying is we're going to pay a dividend to all stockholders that own our stock on July 20th. And so that July 20th, again, is called the date of record. And we don't make any entries. It doesn't affect our financial statements, but it is an important term and date to remember in this dividend game. And then finally, there's the payment date, or date of payment, and that's the date when we actually pay those dividends. And when we do that, we decrease cash. In other words, we credit cash for the amount of dividend, and then we debit our dividends payable for the amount of dividend. So our current assets go down and our current liabilities decrease by the same amount. So let's take a look with National Beverage about what happens to the books on each of these 3 days. So National Beverage declares an 80-cent dividend on each share of its 46 million shares of common stock outstanding. So on that declaration date, what did we say happened? Well, by announcing that dividend, by declaring that dividend, the company incurred the liability to pay that dividend. So what happens is they record dividends payable with the credit because it increases the liabilities for that 80 cents times the 46 million shares, or $36,800,000. And they debit dividends declared, which reduces stockholders' equity at that time by $36,800,000. So we debit dividends declared, we credit dividends payable. And again, there are no entries on the date of record as far as accounting entries go, so we move to the date of payment. So as of that date of payment, the company pays that previously declared dividend. So our cash goes down by $36,800,000, and so does that dividends payable liability because we're paying it now. So we record it with a debit to dividends payable, which reduces the current liability of $36,800,000, and we credit cash to show that our cash is reduced by the $36,800,000 that we're paying to our stockholders. Now, sometimes a company wants to pay a dividend, but they don't want to put the cash back in the hands of their owners. They want to use that cash or send it some other kind of message. And so sometimes a company will pay a dividend using common stock by issuing additional shares of common stock. And when they do that, that's called a stock dividend. So when a company issues a stock dividend, they issue a certain number of shares in proportion to the current ownership of the company. So all of the common stockholders in the company get additional shares of stock, however many the company decides to issue, but the proportion ownership stays the same. So you just basically get a percentage of that stock dividend that's the same percentage of the total stock that you own currently. And so there's no change in total stockholders' equity because no cash has changed hands. We'll show you the entry to actually record that. All we're going to do is move money from retained earnings to additional paid-in capital. And there's no change in the par value of the stock either. So why would companies do this? Well, number one, they might want to remind stockholders that there is wealth accumulating in the company, and this is a signal to do that. Or think about it, if the market value of a company, let's say is $1 billion, and let's say there's maybe 1 million shares of stock out there, you can divide the billion by 1 million and get a market value price or market value per share of your stock. Well, what if they think that that's too high and it inhibits people from investing in shares of stock because the stock price might be per share might be a little bit high? They issue a stock dividend, so you have more shares of stock, but the same market value of the company overall. So the price per share of the stock might go down a little, but there's more shares. Doesn't change the market value of the company at all, but it brings the price per share down a little bit because there are more shares to represent the same amount of total value. Or finally, the company might issue a stock dividend just to kind of signal, yeah, we're doing good things. Here's a dividend. We expect we're going to continue to provide strong financial performance, and sometimes stock dividends are seen to send that signal as well. So how we account for a stock dividend depends on whether we consider it a small or a large stock dividend. Okay, a small dividend or a small stock dividend is a stock dividend that's less than 20 to 25% of the outstanding shares of stock at this point. If that happens, we record the dividend at the current market value of the stock. So we take the number of shares we're issuing as a dividend, multiply it times the market value of the stock, and that's how we record the dividend. Now, I believe in the last slide I said all we're doing is we're moving money from retained earnings to paid-in capital. I meant to say into the capital that was paid into the company, but we're going to end up recording it as common stock. So with a large dividend, if the stock dividend is greater than 20 to 25% of the shares outstanding in the company, then we're going to record those shares at the par value of the stock. And so, you can see in between here, there's a little room for judgment as you're going to account for a stock dividend at a small or as a small or a large stock dividend. So the journal entry, again, just moves them out from retained earnings to other equity accounts. All we're doing is we're saying that what had been in retained earnings is now considered to be essentially permanently with the company because we're moving it into our stockholders' equity accounts. So let's take a look at how we record a stock dividend. So National Beverage issues a 20% stock dividend on its 38 million outstanding shares. So we're going to be issuing 7,600,000 shares of its 1 cent par value common stock. Now, the amount we move from retained earnings to common stock depends on whether we account for this as a small dividend or a large stock dividend. And we are going to, this says to, how do we do it for a large stock dividend? Remember, for a large stock dividend, we record it at par value. If we accounted for this as a small stock dividend, we would record it at the market price of the share. Really, it depends on whether the board of directors really wants to move, how much of that retained earnings they want to capitalize permanently is what it really comes down to. So, to record this as a large stock dividend, what we're really doing is, again, recording it at par value, which is 1 penny per share. So we're really reducing retained earnings by $76,000 and increasing common stock by $76,000. So the entry to do that is to debit retained earnings, $76,000, credit common stock, $76,000. So now let's take a look at a stock split. A stock split basically is just taking a pie. Let's say you have a pie with 6 pieces in it. Everybody owns one of those 6 pieces. And now we take the pie and divide each of those pieces in 2. We now have 12 pieces of pie, and you still have 6 owners, and they each own 2 pieces of the pie. Well, that's all that does, is it splits the pie into more pieces, but everybody still owns the same proportionate share. it increases the number of shares, but when you do a stock split, let's say it's a 50% stock split, you do adjust the par value at that point. You divide the par value in half if it's a 50% stock split. A stock split, again, just creates more pieces of the same pie. If we assume a corporation had 5,000 shares of $1 par value, and they issued a 2-for-1 stock split, they would now have 10,000 shares after the stock split of 50-cent par value stock. So the total par value in dollar terms stays the same, but the par value per share decreased by half, but the number of outstanding shares increased by or doubled. So this slide is just a comparison of the types of distributions we can make to our stockholders. So look at the left-hand column that says before. So this is the way we looked before we did any of this other stuff. We had 1 million shares outstanding, 1 cent par value per common share. So our common stock at par was $10,000. We had additional paid-in capital of $30,000, retained earnings of $650,000 for total stockholders' equity of $690,000. So that's the example we're going to use here. Now we're going to look at it and say we're going to do a 2-for-1 stock split. If we do a stock split again, remember if it's 2-for-1, we're going to double the number of shares outstanding. So instead of 1 million shares, we're now going to have 2 million, but we're going to have the par value per share. So if we had a 1 penny par value, now we have a half a penny par value. So the total par value of that stock doesn't change. It remains the same, as does the additional paid-in capital. So that's all that changes in a stock split. Now let's look at 100% stock dividend. Remember, a stock dividend is where we move retained earnings to our common stock account. So, and we account for it at par if it's a large stock dividend, which this one is. So we do 100% stock dividend, which means we are going to issue. Remember, we had 1 million shares. We're going to issue another 1 million as a stock dividend. And so all we do is now we have 2 million shares outstanding. We don't change the par value per share. And so our common stock goes up by that $10,000, and our retained earnings reduces by $10,000. So with the stock dividend, we're moving money from retained earnings to common stock. Now, let's look at a cash dividend. We pay a $10,000 cash dividend. If we had 1 million shares outstanding of 1 cent par value stock, and we're going to pay a cash dividend of $10,000, what's going on is we are reducing our retained earnings by $10,000, and remember we're paying that out of cash. Cash is an asset. We would reduce that asset by $10,000, reduce retained earnings by $10,000. So our fourth learning objective is to look at this animal we call preferred stock and try to analyze the transactions that affect preferred stock. Preferred stock is another type of stock, and so we will talk a little bit about why common stock is different from preferred stock, and why preferred stock isn't necessarily preferred from an investor point of view, but that term comes from preference that this class of stockholders has in receiving dividends, and we'll talk about that on the next slide. So what is this thing we call preferred stock? Well, preferred stock is a type of stock that has priority over common stock in receiving dividends. So if a dividend is going to be paid to a common stockholder, the preferred stockholders get dividends first, and then if there's enough left over, common stockholders can get dividends. It usually has a fixed dividend rate. So in other words, you will see a preferred stock issued with a dividend rate on it, and that says that each year we will pay a certain amount of dividend on each share of this preferred stock, and sometimes it's called cumulative preferred, and sometimes it's called non-cumulative preferred. So, on cumulative preferred, if a corporation goes for a few years without paying dividends and then wants to pay dividends, they have to make up all those dividends to the preferred stockholders first before they can pay any dividend to the common stockholder. If it's non-cumulative preferred stock and they don't pay dividends for a number of years, then before they can pay a dividend to their common stockholder, they only have to pay the dividend for that current year to the preferred stockholder first, and then they can pay the dividend to their common stockholder. So our example here is National Beverage issued 10,000 shares of its $1 par value preferred stock for $5 per share. So what happened? 10,000 shares times $5 means we receive $50,000 in cash, and now we have to record another type of stock. So we credit preferred stock for its par value of 10,000, and then additional paid-in capital preferred stock for 40,000 is also credited. So let's take a look at this dividend scenario when a company also has preferred stock. And remember, it can be different whether it's cumulative preferred stock or not. Okay, and in this particular case, in addition to its common stock, National Beverage has $1 par value cumulative preferred stock with a 7% dividend rate. Assume 100,000 of these shares are outstanding. 1 year of dividends are in arrears, and the board of directors just declared total dividends of $400,000. How much will each class of stock receive? So, the question is, how much of this $400,000 will go to the preferred shareholders? Well, a 7% dividend rate is calculated on the par value of the stock. If it's $1 par value, then they have to pay 7 cents a share to the common shareholders before they can pay anything to the, 7 cents a share to the preferred shareholders before they can pay anything to the common shareholders. And there's 1 year of dividends in arrears, so they have to make up that year plus the current year, so they have to pay out both those years because it's cumulative preferred stock. They have to pay out both those years before they can pay anything to the common shareholders. Now we'll take a look at how that gets split up. So we have to make up 2 years of those preferred dividends, and so we pay the 7 cents per share times the 100,000 shares, which is $7,000. We pay that to our preferred shareholders for that in arrear year, which is 1 year back, and the current year. So we have to pay a total of $14,000 to our preferred shareholders, which leaves the remainder of $386,000 for our common shareholders. So that $400,000 goes to preferred stock and $14,000 and to common stock of $386,000. So let's take a look at the retained earnings portion of our stockholder equity section. And remember, retained earnings is the cumulative amount of all of our net incomes since the beginning of our company, minus, of course, any net losses we might have incurred and any dividends that have been declared since the company again started operating. In this particular example, we have a company called Baker Company, and it shows in 2008 we had common stock of 100,000, additional paid-in capital of 750,000, and retained earnings of $50,000. Now, in 2009, apparently, the company lost a fair amount of money, and so we show that they have a retained earnings deficit of $70,000 in 2009. Now, that would tell us that at the end of 2009, that would tell us that during 2009, the company incurred a loss of $120,000, because if if the 2009 balance in retained earnings is 70,000 and it started with a positive balance of 50,000, it must have incurred a loss of 120,000 in 2009. So we call that, when you have a negative balance in retained earnings, it's called an accumulated deficit in retained earnings. That can happen. Sometimes companies take a long time to really generate a positive net income from year to year over time. Of course, when you have an accumulated deficit in retained earnings, you can't be paying dividends. And obviously investors don't like to see that, but they might still be attracted to the company because they believe there's long-term potential for that company. So our final learning objective for the chapter, before we look at a little bit of supplemental material, is to analyze the earnings per share, return on equity, and price earnings ratios associated with the stockholders' equity section of a financial statements, of a balance sheet. Now remember, being able to understand the analysis of these pieces of the financial statements is as or more important than being able to record transactions properly. The reason we're going through all of this is so that we can get to the point of being an analyst, of understanding what's going on in these organizations, and that's where these ratios and other measures come into play. So first we're going to take a look at earnings per share. Almost everybody has heard of earnings per share. It is the most widely watched financial ratio in the financial markets. The way we do earnings per share, think of what it says. Earnings, which is the net income of a company, per share of stock. So we look at the average number of common shares outstanding. So earnings per share is associated with our common stock, and we're just looking at the earnings per share of common stock. And we look at the average number of shares. So we take the number of shares that were out there that were issued at the beginning of the year, and we take the shares that were outstanding at the end of the year, add those together, divide by 2. That gives us the average number of common shares outstanding. So National Beverage income for 2008 was $22,500,000. The average number of shares outstanding during the year was $45,900,000. So our earnings per share was 49 cents per share. That is one thing all investors look at in trying to analyze the effectiveness of the performance of an organization. The next measure we're going to look at is return on equity. Remember, equity is what owners put into the company, and so the return on equity is what we're earning on, what kind of return we're generating on that investment that our owners are putting in the company. So there again, return on equity is our net income divided by our average stockholders' equity. So we take stockholders' equity at the beginning of the year, stockholders' equity at the end of the year, divide by 2 to get average stockholders' equity, and then we divide that into the net income for the year or the period. National Beverage's income for 2008 was $22,500,000, and the average stockholders' equity was $151 million. So our return on equity for National Beverage was 14.9%. Now we can look at that from year to year and see if our returns are improving, or we could look at it and compare ourselves to other companies within our industry, other companies in other industries, those types of things. So there's comparative power in being able to look at these different measures. Finally, we're going to take a look at this thing we call the price-earnings ratio. Basically, it's a measure of value that investors place on the company's common stock. In other words, they are projecting through what they are willing to pay for the company, what they think the long-term performance value of this company is going to be. And so a higher price earnings means that they're willing to pay more for $1 of earnings than they might for another company, probably because they think that the future of this company is stronger than this other company that they might be that might have a lower price earnings ratio. So what we do for price earnings is price refers to the current stock price per share, and we divide that stock price per share by the earnings per share that we just learned how to calculate, and we come up with what we call a price earnings ratio. National Beverage's stock price was $7.74 per share when we recorded or reported its 2008 earnings per share of 49 cents. So that means it had a price of 50.8 times its earnings per share. And that again, you can use it as a comparison against other companies, or even from year to year of your own company, for what investors might be thinking the long-term potential is for this company. A higher price earnings ratio means that the investors feel pretty confident in the future performance of the organization. So we'll take a look at what investors might look at. We'll look at this comparison between two companies, National Beverage and PepsiCo. And so in 2008, earnings per share of National Beverage was only 49 cents a share, whereas PepsiCo was $3.26 a share. Return on equity for National Beverage was 14.9% return versus return on equity for PepsiCo of 34.8%. Now, some of this could be attributable to PepsiCo might be leveraged more highly, therefore have fewer shares outstanding, and so they would be looking at higher returns and some of those things. So if we take a look at the price earnings ratio, the investors are valuing the long-term prospects of each of these companies about the same. You can see a price earnings ratio of 15.8 for National Beverage and a 16.0 price earnings ratio for PepsiCo. But also, if you think about it, look at what the earnings are. PepsiCo was $3.26, whereas National Beverage was only 49 cents. So these